Welcome to Techcast Live.
Generally, different countries have their own laws when it comes to taxing digital currency.
That's right. In the United Kingdom, for example, capital gains tax rates on disposing of cryptocurrencies are 20% for higher and additional rate taxpayers and 10% for basic rate taxpayers.
In the United States, the Internal Revenue Service, IRS, considers cryptocurrency to be property rather than cash, so it is taxed ranging from 0% to 37%. Income from a business is taxed in its entirety in Canada, but capital gains are only taxed 50% of the time.
And in Australia, cryptocurrency held for more than 1 year is eligible for a 50% capital gains tax deduction. And in India, the nation has imposed a 30% tax on any revenues derived from the transfer of virtual assets. So, as you can see, tax policy differs quite a bit when it comes to cryptocurrency from country to country.
That's true. Now let's move on to the European Union's approach to cryptocurrency taxation. The EU has managed to create a uniform set of rules for crypto across the Union called the Markets in Crypto Assets, MiCA regulation. This framework also establishes supervision for cryptocurrency markets and gives regulators the power to investigate and prosecute cases of market manipulation and fraud.
Indeed, the EU also focused on the misuse of the crypto industry for illegal activities, such as money laundering and financing of terrorism. The MiCA regulation is aimed at better protecting Europeans who have invested in these assets and preventing the misuse of the crypto industry for such illegal activities.
Right. The EU has also established new tax transparency rules for all service providers, facilitating transactions in crypto assets for customers resident in the EU. Fair and effective taxation is a cornerstone of this initiative, aimed at securing revenues for public investment and services while fostering an environment conducive to innovation.
That's right. All crypto asset providers based in the EU, irrespective of their size, are required to report transactions of clients residing in the EU, and these rules are due to enter into force on 1 January 2026.
It's also worth noting that the EU's approach to cryptocurrency regulation and taxation has been recognized as relatively open and proactive compared to other jurisdictions. For instance, U.S. Securities and Exchange Commission, SEC, Commissioner Hester Peirce recently commended the UK and the EU for their stance on crypto regulation, pointing out that the U.S. could learn from their regulatory regimes.
So there you have it, a snapshot of cryptocurrency taxation in Europe and how it differs from other countries around the world. France categorizes cryptocurrencies as movable property and subject to capital gains tax. Gains from selling cryptocurrencies are taxed at a fixed rate of 30%, which includes the 17.2% social contribution. There are no tax exemptions for holding cryptocurrencies for a prolonged period. Companies that receive cryptocurrencies as payment must convert the transaction value to euros and pay value-added tax on that amount, while also reporting all transactions to the tax authorities.
In the UK, cryptocurrencies are treated as assets, subject to capital gains tax. The tax rate varies based on an individual's income and the length of time the cryptocurrency is held. Additionally, there is an annual tax-free allowance for capital gains, which can be applied to cryptocurrency profits. Businesses must convert the transaction to British pounds and pay VAT. If they use cryptocurrency for salary payments, then income tax and national insurance contributions must be calculated in British pounds. The UK's approach is comprehensive, covering various aspects of digital currency transactions with an annual tax-free allowance and different tax rates based on income and holding periods.
Now that we discussed the different approaches to crypto taxation in Europe, let's go over some of the challenges associated with such taxation. Cryptocurrencies are very volatile, making it difficult for tax authorities to ascertain exact amounts of transactions and gains for tax purposes. Additionally, cryptocurrencies provide users with some anonymity, and there are no global regulatory standards for taxation, making it possible for individuals and corporations to engage in tax evasion by taking advantage of variances in tax legislation among nations. Finally, taxing cryptocurrencies can be a difficult procedure due to the complexity of factors involved, such as length of time a coin is kept in various tax rates between countries.
To address these challenges, European nations need to establish a standardized valuation method for pricing cryptocurrencies across Europe, while also enhancing international cooperation between regulatory entities and fostering transparency through reporting requirements and anti-money laundering, AML, and Know Your Customer, KYC requirements. Additionally, leveraging technology like blockchain analysis, tools and artificial intelligence can assist in identifying trends of noncompliance, while clear guidelines and resources can help taxpayers understand their duties regarding Bitcoin taxes.
So we discussed why cryptocurrency taxation in Europe is complex but important. It allows individuals and businesses to benefit from digital currencies while minimizing risks associated with illicit activities like tax evasion.